Thank you, Mr. Chairman, and thank you to our witnesses for being here today. I want to first applaud you all for addressing the ESLR so that it serves as a backstop to risk-based requirements rather than a binding constraint on intermediaries. As chairman of the Task Force on Treasury Market Resilience, I am keenly interested in making sure our capital framework doesn't disincentivize participation in the Treasury market. I'll start with Vice Chairman Bowman, then Comptroller Gould, and Acting Chair Hill. You've adjusted the ESLR. Would you consider adjusting other leverage ratios as well?
Congressman, at this time, we're widely reviewing all of our authorities and certainly are vested in the success of the Treasury market, including the intermediation by our largest banks, which is why we have finalized the ESLR proposal. So absolutely, we would be happy to look at anything that you might like us to consider broadly.
Two points, Congressman. One, as you probably know, we are in the process of adjusting, or at least proposing to adjust, the community bank leverage ratio. More generally, I share your concerns of the impact of overly complex capital regulation that we've seen following 2010. In particular, how it has, in many cases, caused banks to pull back from their historic role of market intermediation. I've also seen firsthand, too, in March and April of 2020, again, the cost of complexity associated with, again, overwrought capital regulation and the ability of that overwrought capital regulation to actually impede crisis management when there's an issue, again, as we saw in April and March 2020.
Acting Chair Hill.
All I would add is just to say, as you note, the final rule on the ESLR was intended to remove disincentives for institutions to provide Treasury market intermediation and other low-risk types of activities. We have a proposal out to modify the community bank leverage ratio, and we'll continue to reevaluate other pieces of the capital framework.
On that same topic, the government shutdown, quantitative tightening, and a reluctance to use the Fed's standing repo facility have raised concerns about reduced liquidity in the Treasury market. Vice Chair Bowman, as you finalize the Basel endgame proposal, how will you keep in mind the implications of the capital requirements on Treasury market liquidity and functioning, given the Fed's report that the banking system is well capitalized? Do you expect to increase capital levels?
I think we're currently in the process of reviewing the capital framework by looking at all four of the pillars of capital, including SLR, which we've just finalized and addressed. As my colleagues mentioned, we jointly proposed the CBLR, which is designed to help community banks. It's critically important that whatever the frameworks are that we create, and the other pillars that we're working on and reviewing is stress testing, which we've introduced a few proposals on this year. The GSIB surcharge will be a part of that, as well as the Basel III proposal that we are currently engaged in working on. It's critically important that all of the work that we're doing does not result in impairing the ability of the banks and the economy to support the Treasury market and its functioning. So we're certainly attuned to any risks that might be presented by the calibration of those proposals.
Acting Chair Hill, last quarter, the Deposit Insurance Fund reserve ratio increased 4 basis points to 1.4%. Is that correct?
Yes, that's correct.
I understand you can't predict to an extreme degree, but would you expect the reserve ratio to decline if Congress were to increase deposit insurance for non-interest-bearing transaction accounts over a 10-year framework?
The way the phase-in period works in the Haggerty-Alsobrooks bill in the Senate, there is a lot of uncertainty around any predictions that we would make, but based on the projections that our staff put together, which again are subject to considerable uncertainty, the expectation would be that the reserve ratio would grow more slowly over that 10-year period rather than decline. But again, want to emphasize that there's a lot of uncertainty around those projections.
One final thought, Chair Hill. I continue to hear frustration from small banks in Oklahoma that during the bank failures of March 2023, the FDIC stepped in to backstop depositors, but the same action wasn't taken to a bank in Lindsay, Oklahoma, the very next year. The difference in the FDIC's actions was because the banks that failed in 2023 were too big to fail, while the bank in Lindsay was too
Gentleman's
small to
time has
succeed.
expired.
Thank you, Mr. Chairman.